Thanks for staying with us on the marketplace. First up, the International Monetary Fund is expressing worry about the expected slowdown of Ghana's growth rate. The fund's latest World Economic Outlook report also forecasts a slowdown in economic growth across the globe. It therefore warns of more challenging times for emerging economies going forward. Chief economist at the IMF, Pierre-Olivier, explained that the tightening of policy rates by central banks in the U.S. and other developed economies will have a negative impact on emerging markets.
Think about the downside risk that we're facing in the coming month and year, the financial tightening, which has been relatively orderly in its impact on especially emerging market economies up until now. There's been a lot of differentiation. Spreads have been going up. Interest rates at which countries borrow have been going up. Currencies have been depreciating. But there's still a lot of market differentiation between, for instance, commodity exporters versus commodity importers. Going forward, however, it's very clear that the tightening in the by the major central banks is going to have continued effects on the rest of the world. And we can think about basically three channels. First, there is going to be reduced demand and economic activity at the global level. That's going to weigh down on countries that rely a lot on the export sector for their growth. That's going to affect them through this channel. The tightening in the U.S. and other central banks around the world is also leading to a major appreciation of the U.S. dollar against emerging market currencies, and that is increasing inflation pressures in those countries. So these countries are facing higher inflation numbers because there is imported inflation. All the price of the imported goods are rising faster because they are expressed in dollars. And then there is just the fact that when we have a cycle like this, there is in general what we call a flight to safety. There is a general tendency by investors to maybe move away from emerging market economies and seek safe havens, invest in U.S. treasuries or in other safe assets around the world. We've seen the capital flows moving out of emerging markets in the last 4 or 5 months. It's been quite persistent. There's been a lot of capital outflow. As I said, it's been quite orderly until now, but it's adding pressure on domestic and sovereign rates, and that's reducing fiscal space. That's also making it harder for the private sector to also finance itself. So all of these things are going to weigh down on emerging market economies, which so far have been, as I've said, has been quite orderly. A number of emerging market economies have improved their policy frameworks, the way they implement monetary policy, the way they deploy other instruments, macroprudential instruments, to guarantee the stability of their financial sector. So things have not been too disorderly up until now. But of course, we are concerned as to whether this might continue in the future.
That was Chief Economist with the IMF, Pierre-Olivier there. Well, let's speak with financial analyst and management consultant, Christian Techijan, who joins us for more on this. I just need to point out that the IMF's growth target for Ghana, revised growth target, is pegged at 3.6%. And now we had the finance minister earlier this week revised our growth target as well from 5.8% to 3.7%. I want to ask you, first of all, Christian, and welcome to the marketplace, your first time on the show. How realistic is this revised growth target for Ghana?
Thank you very much, Daryl, for having me on your program. For me, we are all very much aware of happenings across the globe, and we've had a number of economic targets being reviewed, and even in the strongest of economies like the USA and the Eurozone. Globally, the IMF is expecting the world economy to grow only by about 3.2% in terms of GDP, from the earlier projection in 2021 of 6.1, which is just about 50% downward revision. With sub-Saharan Africa, it is expected to grow its GDP by about 3.8%, and it came as no surprise with the government reviewing Ghana's GDP growth from the expected 5.8 to the current projection of about 3.7. On the side of inflation, it is also expected to reduce from the June figure of 29.8% to 28.5%, which is very marginal from the 8% target government had set earlier. And for me, this will not really do that much in affecting the livelihood of Ghanaians. I would say there is, however, an upbeat with the government expected to improve on its fiscal deficit. And I'm suspecting this is coming from the backdrop of the improved revenue generation, as well as the imminent intervention from the IMF. So, Daryl, in all of these, if you want to baseline and benchmark these figures, I'm of the strong belief that these targets are actually achievable.
Uh, and on what basis, again, I need to ask you, do you think this is achievable? Looking at the mid-year review, the presentation by the finance minister, do you see that they are investing in the right areas of the economy to meet this target?
Yes, government has set out certain strategies to improve upon its income generation. And for me, those strategies are workable. And with the imminent intervention from the IMF that is having the effects to show up what our city is doing, I'm sure they should be able to achieve it comfortably. Because for me, a lot of some of these fundamentals are dependent on the how our interest rates are and how our FX in terms of our cedis performing against the major currencies, including the USD. So once we have a buffer that is coming from the IMF, I'm sure it will make our cedis stabilize and we can kick on from there to improve upon the other fundamentals.
Well, the submission from the IMF chief economist makes mention of the global economic slowdown. So it's not just Ghana in this, it's a global problem. And the IMF raises an important warning that the crisis we are seeing across the globe, the impact is going to be felt by emerging economies like Ghana. So how do we navigate those external factors?
There are a number of sectors that I would say government hasn't really looked at it. If you look at the import base of the country, is quite small. I'm sure the 1D1F project that the government started, from now we should be seeing some response in terms of impact that is coming from there. There is also the non-traditional exports, including the cashew, which I believe last year did better than the previous years. And government has set out certain strategies that is going to improve upon its production and the consequent trade. So I'm upbeat with those strategies being put in place, coupled with the income generation mechanisms that the government is actually putting in place. Yeah, they should be pretty achievable.
Christian Techi-Jan, great to speak with you for the first time on the marketplace. Hope to speak with you another time. Thanks for your thoughts this afternoon.